Hi, and welcome to this new presentation, Cost of Capital. Remember that investors provide capital to businesses or to projects and are expecting a return on their investment. For the business or for the project, that return in the form of a percentage is the largest part of the cost of that capital for that business or for the project. So the cost is not exactly the return. The cost of capital will also consider different fees that might be engaged in order to obtain the financing, like broker's fees, analysis, legal fees, or income tax will also be considered. Because depending on the source of capital, you might receive a deduction from income tax. Let's say you pay interest on a loan, that is deductible. So we will consider the tax effect on that type of return. So the different components of a firm capital. The firm's capital is made up of debt or liabilities, monies that are borrowed, either through loans or bonds. Common equity, shares, retained earnings. Preferred shares, these are a cross between debt and common equity. In other words, preferred shares, they will create a dividend, but normally the dividend is fixed, it's predefined, and it is guaranteed. What we're going to call the capital structure is a mix of all of these different components. How much of each source will your project or your business use? Remember the debt ratio or the debt to equity ratio. These are ratios that dealt with capital structure. The target capital structure is the mix that's optimal for you, the mix that's giving you the best of all these worlds and using each one of these tools to an optimal point. Now remember that each different tool, bonds and shares, we saw this earlier, depending on the level of risk, will have a different yield to the investor or a different cost to the business. Since equity is generally seen as riskier than debt, generally it will give a higher return, thus a higher cost to the firm.
Another thing to consider is the yield curve. Normally, yield curves are always slanting upwards the longer the term of the debt. In other words, what you have here on the screen represents the structure of interest rates for short-term to long-term debt from 1983 over to 2012. So in 2012, if you were to get long-term debt, you could get it at this rate, about 1%. If you're looking for long-term debt over 10 years, you're looking at something around 2.25%, somewhere in that area. If we look at different years, 1992, for example, 2% for a short term, over 5% up here for long term. 1983, if you would have borrowed money for on a short term basis, you were about 9%. On a long term basis, 12%. How does this get explained? Well, normally the longer the term, the more risk there is for the lender. First of all, market conditions. Will market conditions continue at these rates? Can I expect this type of rate for a longer term? So if he's locking in a loan for 12 years, well, maybe it'd be better off locking in for 2 years and then just giving you a new loan thinking that rates might have increased. So if he's already locking in for a long term, he's going to ask for a higher rate right away. That's the first thing, market. Second of all, how can you actually forecast what events are going to happen? If I give you a loan over 1 year or 3 months, it's pretty easy to forecast if you're going to have the cash to repay me and what your situation is going to be. What is your situation going to be in 5 years or in 10 years or even longer than that? Becomes much harder to figure out. If it's harder to figure out, there's more risk involved. There's more risk for the lender. The higher the risk, the higher the return. So same thing here that we saw in the previous slide. If there is more risk can be associated to timing, the more expensive your debt will become.
Financing a project, internal versus external. So internal sources of financing, basically net income. The net income can provide funds that will be reinvested into the projects. external financing, equity, issuing new shares, retaining earnings, debt, bonds, term loans, mortgages, credit lines. Rental can also be a form of financing a project, short or long-term rental leasebacks. The return to the investors represents the cost to the firm, the direct cost to the firm, let's call it that way. The cost of capital is not exactly equal, but it is related because the cost of capital must include the impact of what we're going to call flotation costs and income tax. So what are flotation costs? Remember, I've said this earlier on, mentioning that sometimes you will have administrative fees, commissions, other types of fees that might be involved when you're issuing or selling new shares. Or if you're going to a bank and you're getting a loan, there might be different costs associated to all of this process. We're going to call these flotation costs. Remember, there are no flotation costs on retained earnings because these are amounts that are already inside of the business. So we won't be calculating any type of flotation costs when we talk about retained earning. It actually reduces the amount that you received from a security. In other words, if you're selling shares for $1,000, you actually do not receive the whole $1,000 because you need to pay commissions. You're actually earning a bit less. So in order to incorporate flotation fees,
we'll have this equation down here where K is the cost of capital, R is just a generic form for the return.
And we're going to divide it by 1 less the flotation fees. So let's start with the cost of equity. This is the return that's required by the investor on his investment. Is the generally where we have returned earnings, where we have shares that are issued. They might have different costs. The cost of common equity is kind of imprecise because of the uncertainty of future cash flows. So we kind of have to estimate this for the future because we don't know exactly what the future is going to bring. So we're going to estimate the dividends that should be given, D divided by the value at the beginning. In other words, your estimated current return. Why don't we add in here the capital gain return? Because the capital gain return is not really paid by the business. Remember, it's not a cost to your business if the share gains value on the market. So your cost is actually how much money did you get from this investment, how much money came into your business, and how much are you returning in dividends to your investor. So the formula, we're gonna find out what K is by estimating the current return, divided by 1 minus F if there is any type of flotation costs. Retained earnings are not free. So that remember, there's no flotation cost here, but if you are using retained earnings, you still need to give some kind of return to your investor. So we do have to calculate, even though we haven't given him back his money, we're not giving him back a return directly, he is expecting that money to grow in some way. The cost of capital would be equal to the current return. Note, even when an investment is equity that does not take the form of a security, the investor is still expecting a return. He can't invest the money elsewhere. This is going to be called opportunity cost. So you need to remember this. The return that investor does not obtain, that's going to be called opportunity cost. If you remember in one of the assignments, we needed to buy a photocopier. And we tried to figure out, what if I buy it cash? I put my money on the table, buy my photocopier right away, or if I turn around and rent the photocopier. A lot of you said, sir, this is simple. If I'm renting, I'm paying interest. If I'm not renting, I'm paying cash. There's no payment associated to this and no interest. So of course the solution is going to be the first one, buying the photocopier. Well, not really. It isn't that simple. Because remember, if you put that money into the photocopier, if it's, let's for example, $6,000, I think that was the amount we were investing. If you put $6,000 into that asset, you don't have that $6,000 to do other types of investment. You would be asking that photocopier to at least give you the same amount of return, the same percentage of return that you would have gotten from another type of investment. That is called opportunity cost. In other words, if I cannot use that capital to do something because I've tied it up into an asset, I'm losing the opportunity to do another type of investment. The cost on my asset is what I'm losing somewhere else. This is really, really important, mostly if your project does not create a real return, just like the one I just explained with a photocopier. Cost of debt. The cost of debt will be reduced because there's a tax deduction associated with interest payments. Remember, interest is an expense that is tax deductible. So we need to modify a little bit that rate in order to incorporate that information. So the cost of the debt, in other words, the interest rate here, we're going to multiply by 1 minus t, where t reflects the tax rate. Notice that you also have 1 minus f under there. If you have flotation costs, you can include your flotation costs directly in the calculation of the cost of the debt here. For example, this company, Blackstone, they've emitted a bond. 8% is the rate that they're paying. Their marginal tax rate, their tax rate on each new dollar, 37%. So we would calculate the cost of capital, the cost of the debt, by multiplying the rate, 8%, by 1 minus 37%. So 0.37 gives you 5.04. That is the actual rate that we're going to look at for cost of capital. It does not replace the interest rate. He still pays out 8%. That's the actual cash coming out of his pockets. But there's a tax incentive to this, bringing it down to 5.04 as the cost of capital. Now, if the flotation cost on a debt takes more the form of monies that are outlaid to obtain the debt, you might need to recalculate the interest rate completely. It might be simpler than to try to estimate what is the F as a percentage. So what we need to do here is to recompute I. So P0 will be the net loan proceeds, the amount of money I receive from the loan less all of the fees. Payment, I'm going to reuse the payment that was originally computed for the total loan amount. N stays the same. Now with all these variables, the new P0, the old payment, N, I could recompute I, the interest rate. The interest rate that incorporates the fact that I'm not getting all of the loan amount. Here's an example. Maybe it's a bit easier to see this way. So your business is obtaining a loan for $1 million to purchase an asset. However, your lender is asking you to produce different studies and produce documents to secure that loan. That's costing you $23,000. On top of that, he's charging you a fixed $30,000 amount. Loan amortization, 10 years, your rate, 7%, compounded 12 times a year. So what we want to do is recompute I in order to account for all these fees. The first thing I do, I computed PMT. That was the first thing I did. Using $1 million, 10-year amortization, 7% compounded monthly, I computed this to $11,610.85. That's my payment. Am I actually going to receive $1 million? No, I'm receiving a lot less, right? Because I have to pay all these fees. So I'm going to recompute. Keep the payment inside of the calculator, or keep your payment fixed somewhere on Excel if you've done it this way. And we're going to recalculate something else. We're going to recalculate I, taking into account $1 million minus the fees, $23,000 and $30,000. So your net proceeds are actually $947,000. That's what you actually have in your pockets. You need to repay that $1 million, but you've only obtained $947,000. N stays the same, 120 payments. We're going to recalculate I. I becomes 8.241%. That would be your cost of capital, already incorporating the flotation costs that here are shown as dollar amounts. So if you're doing this, you don't want to enter the 1 minus F inside of your calculation, okay? cost of capital on the lease. We're going to estimate the interest that we're paying on that lease by using PV, the future value, the payment, and N in order to isolate I, the interest rate that's being charged to your business by the renter. Again, the interest rate here is not, the interest payment is not going to be visible because what you're paying to the renter is in the form of a total rent. That includes capital, it includes interest, but it is fully deductible and it's paid as one sum. We're going to base our cost of capital for leasing on this interest rate by doing I multiplied by 1 minus T, which is the tax rate, divided by 1 minus F if there are any flotation costs. Now, maybe you've seen the error here. I'll show it to you. We're actually doing the I, so the interest rate. We're multiplying only the interest portion by the tax benefits. There's a little error here because we should be taking the tax consideration not only on the interest but on the total rent value. So we're going to keep it this simple for now, but be aware that there is inside of this simplification kind of in a little error. We're kind of underestimating the tax effect. Now that we know the cost of capital for each and every source that we have, what we want to calculate is a weighted average cost of capital. WACC, W-A-C-C is the abbreviation. This is the average cost of each separate source that is being weighted. In other words, what is the proportion of a certain capital source that we're going to multiply by its actual cost. For example, we have a capital structure here made up of long-term debt, preferred shares, and common shares. So 3 different sources. Not the same values. Long-term debt, 200,000. Preferred shares, 100,000. Common shares, 300,000. So each of these sources has a different weighting. And we have here on top all the values concerning the current dividend, the yield, the interest rates, all that. Let's go see how that works in here. So the cost of debt, the interest rate, we saw up there 10% was our interest rate, 45% is the tax rate. Flotation cost was estimated at 0.5%. So the cost of capital, what we would do here, 10% multiplied by 1 less 45 divided by 1 less 0.005. And if you've calculated all that, you'll notice that the cost of this capital source is 5.53%. That's what we're showing up here. When we bring it down to the weighted average cost of capital calculation, we're going to see that the long-term debt, 33% of our capital structure, so $200,000 divided by the grand total of all of our debt, all of our capital, sorry. If we do that, we'll see that 1/3 of all of our capital comes from long-term debt. The cost is 5.53%. If we multiply both of these together, we'll get a weighted cost for this source of 1.84%. We'll do the same thing for the preferred shares where we're calculating the return. So D divided by P, so the value of the share and the dividend gives me 8.33%. That is what we're paying out to our preferred share investors. They own 16.67% of the capital. Multiplying both of those together, 1.39. So the last part, the common shares, we see their current dividend, we have a growth rate in a common share price, and we can estimate the next dividend. So the current dividend is $2. What we want is the future dividend. So $2 plus the growth. And we're going to divide that by the common share price today in order to calculate what is the estimated dividend in the future. The cost of that capital, 5.68. In this calculation, we had no flotation fees in here, so 5.68 is directly the capital cost. When we bring it into the capital cost, the weighted capital cost, 50% of our capital structure is common shares at 5.68%, which gives me 2.84. I'm going to add each one of these weighted costs together in the weighted average cost of capital. will be 6.07%. Now, if each one of these sources had exactly the same weight, if I was using 1/3 in long-term debt, 1/3 in preferred shares, 1/3 in common shares, we would not have to go through the whole weighting process. We could just do an average, basically. It's 5.53 plus 8.33 plus 5.33, 68, and divide that by 3, and that would work. Because each source is not equally weighted inside of the capital structure, that's why we need to go through the weighting process here in order to see the impact on the total weighted average cost of capital. The purpose of calculating cost of capital is going to be used as a hurdle rate or a benchmark in capital budgeting. In other words, we're going to compare the IRRs of a project. Remember, we were looking at IRR of a project and we were trying to compare it to another value. Well, this will be a good hurdle rate. If my IRR of a project is higher than the cost of capital, than the weighted average cost of capital, then we have a project that's actually going to pay off all of these investors and pay them what they want, and there is more return. So we're going to probably bonify some of these investments. We're going to discount different cash flows at this rate to find NPV. Remember, in the assignment, since we've been using NPVs, I've always been giving you, do the NPV at this rate. I told you we would see later on, how do we estimate this rate? Weighted average cost of capital. Again, here, the graph shows you exactly this. Your cost of capital, if we're saying that your average cost of capital, your weighted average cost of capital is of, let's say, 6%, like we had in our example, well, that stays fixed. If your project is earning more than this cost of capital, there are funds for these projects. The closer you get, well, the more risk there is that your projected IRR might just not meet this and become lower. So the closer you are to the cost of capital, the more risk there is involved. If your projected IRR is already lower than the cost of capital, forget it. There's no funds for these projects.